Do you know the number one reason why traders blow their accounts? It's actually not trading the wrong setups. It is having the wrong strategy for the market environment. There is a critical difference between trading in a trending and in a ranging environment, so your trading strategy has to be adjusted accordingly. If you're trading the wrong strategy in a trending market, you can run into avoidable losses. So in this video, I'm going to show you how I am identifying a ranging or a trending market and how I am adjusting my strategies. So let's have a look. Let's now get into the charts and have a look at the difference between a trending and ranging environment, how to spot it, and how to adjust the trading strategy accordingly. When it comes to trending and ranging environments, for us traders, it's extremely important to always be aware of the high time frame but also low time frame trend. We have to adjust our strategies and also need to know if we are in a trending or ranging environment to make an informed decision about our risk management. Markets can be broadly classified into two types. Trending means moving in a clear direction, and ranging means moving sideways without a clear direction. The purpose is recognizing the type of market you are in, because it's crucial for the right trading strategy. It can impact our trading decisions, so different market conditions require different approaches. What works in a trending market may fail in a ranging one. That is already a key learning for you. The trading strategy that is working in a trending environment might fail in a ranging environment and has to be adjusted accordingly. But I will obviously cover that. So let's first have a look at a trending market. What actually is a trending market? So a trending market occurs when price is consistently moving in one direction, either upwards, which is classified as an uptrend, or downwards. So the characteristics of an uptrend is higher highs and higher lows for an uptrend. So prices is forming higher highs and higher lows. A downtrend is characterized by lower highs and lower lows. So that means in a downtrend, price forms lower highs and lower lows over a period of time. So let's have a look at this and actually mark out a uptrend for Bitcoin. So what we can clearly see is that Bitcoin is in an uptrend, so we can see prices going up. But how do we actually select the pivots for us to decide if this is a valid uptrend? So first and foremost, we need a low. This is the low down here at around 16,000. Then we can see prices making a higher high in relation to this previous significant high that we've had here. Followed by that, price formed a higher low. So in relation to this previous overall low, price is clearly making a higher low. Next, we can see that price is forming a higher high. So this is already a confirmed uptrend because we have the three pivots that we need. Let me pause here and mark it out. So the first pivot we need is the higher high. Okay, so this can be classified as number one. Pivot number two we need for a trend to establish is a higher low in the event of an uptrend. This is given down here. And upon the break of this previous higher high, we get a confirmed market structure change. This is right here because we can see that previous higher high is breached again. So at this point, this can be classified as a valid uptrend and a confirmed market structure change to the upside. So let me hide a couple of levels and continue this uptrend on Bitcoin. So I want to use that tool again and continue where we left off. So here we can see price again is forming a higher low. This is followed by a higher high. And then we can see one very interesting thing down here. So what we see is price is technically forming a lower low. Why can that still be classified as an uptrend? And the reason for this, which is something you want to note down, is that we have only seen a liquidity grab. So what we can see is price wicks into the level, but we don't get any candle closes below the previous low. So for me, that means we have technically not changed the market structure and rather taken the liquidity below a significant point to drive another move to the upside. So as a reminder or as something to note down, if a liquidity is only taken below a previous low or high and candles are not closing below, I am not classifying this as a market structure change. So let's continue with this trend. After that, we can see price again is forming a higher high. This is followed by another higher low. Price is forming another higher high, higher low, and another higher high. So this is a very perfect uptrend on Bitcoin. We can clearly see how price is forming higher highs and higher lows. So when it comes to choosing the right trading strategy, we obviously have to go with the trend. So why would it make sense to try and fade this move, look for short trades and aim for new lows when we see that the market is simply forming higher highs and higher lows? So let me show you what I mean by that. Let's say, for example, up here we are looking at a key resistance and want to take a short trade. The aim for this short trade is to make a new low. Now for us traders, we have to analyze market structure and say, is it really likely to form a new low if we're seeing a clearly bullish market structure and price is making higher highs and higher lows, and thus we have a lower probability to actually take these lows. So for us traders, we have to adjust the trading approach, and that means we have to take profits a little bit quicker. So when I am counter trading a trend, I always need a quick take profit one, and upon hitting take profit one, I want to move stop loss to break even. Now, on the opposite side of things, when I'm going with the trend, so let's, for example, I'm looking for a long trade down here because I identified key support down here. I can aim for a new high to be made because I am going with market structure. Okay, so at this point, I am less inclined in taking a quick take profit one and rather more interested in letting a trade run. And even after hitting take profit one, I don't necessarily have to move my stop loss to break even. I can obviously do that, but I don't have to. And I typically leave a larger position of this trade open for a scenario that we simply get continuation of a trend. And I obviously want to be exposed to this nice uptrend, and I don't want to fold this entire trade too early because I want to still profit on this uptrend. Now, as a trader, I'm obviously capable of identifying these trend changes, and once a trend changes, I can start thinking about reducing my position again and de-risk my position. So whenever I go with the trend, I am more conservative with the take profit one and leave a larger chunk of my trade open. So we have to keep in mind that we do have trends within trends. So here we're looking at a high time frame trend. But for day traders or scalp traders, they might identify a low time frame trend that is within the bigger trend. So for the day and scalp traders, although we can still take short trades within a higher time frame uptrend, we always have to be aware of the higher time frame trend and keep that in the back of our head. So whenever I am planning a day trade or even a scalp trade, I always know what the higher time frame trend is looking like, and I always factor that into my trading decision. Besides that, once a clear trend is identified, for us traders, it's obviously best to go with the trend rather than chasing it and look for longs on pullbacks. In a ranging environment, it doesn't make too much sense to long every pullback or short every rise. Whereas if we are trading in a clear trend, we should wait for pullbacks to fill our long trades. And in a downtrend, if we look at this, for example, where price is clearly forming lower lows, lower highs, lower low, lower high, lower lows, so this is classified as a downtrend, we should short the rises. So let's now have a look at the difference and have a look at a ranging environment. So for this, I want to choose an example on Ethereum, and let's clarify what a ranging environment is. So a ranging market occurs when price is moving sideways within a defined range. That means bouncing between support and resistance levels. So let's have a look at this on Ethereum. Well, we can clearly see that price is rejecting a resistance level and price is clearly bouncing off support down here. We cannot identify a clear trend and rather view this as a consolidation or ranging market. So here we can clearly see that price is fluctuating within a horizontal range without establishing a clear trend. The market is confined by support levels, which is the bottom, and resistance levels, which is the top. So let's have a look at how we would have to adjust a trading strategy if we are trading in a trend. So say for example, I am looking for a long trade down here. I have identified a support level down here, and I also identified that price is trading within a range. So in a market or in a ranging environment, I would obviously aim for a new high because I'm going with the trend and I'm expecting this trend to continue. Whereas in a ranging environment, it does not make sense to aim for a new high because we can see price is kept within the range. So the probability of taking the highs at this point is pretty low. So for me as a trader in a range, I have to look for take profits that are inside the well-defined support and resistance areas. I'm not aiming for a move above a high and rather look at something in between where I'm taking profits. For me, this means taking a larger take profit than trading with the trend. When I'm trading in a range, I'm typically taking 75% take profit 1. So that means on the first take profit, I'm reducing I'm taking off the majority of my trade just for a scenario that this range is continuing even longer. So I'm always keeping 25% open because as we have seen here, at some point a range is going to break. I myself am not a breakout trader, so I would never trade the break of a range. But if I'm already in a long trade from the lows, I want to be exposed for if we get a nice move above the range high. So when it comes to trading a range, what I typically do is long the range low and short the range high. So this means in a trending environment, I am less interested in taking short trades and I am more interested in longs on pullbacks, which makes sense, right? But when it comes to trading a range, I'm open to trading both sides of the market. So whenever we see a move into the range lows, I'm looking for long trades. And if we start to see moves into the range high, I'm looking for short trades. And thus I'm positioning myself with both or in both sides of the markets. And there's one golden nugget I can share with you, and that is if you manage to get into a long trade at the range lows, I would never close this long trade even when I'm taking a short trade at the range high. So this allows me to be exposed to the market wherever it is going to break. So here, for example, say I have taken the long trade on Ethereum at the range lows, and I'm also in the short trade on Ethereum from the range high. So at this point, for me as a trader, wherever this market is heading to next, I am making money. If I get stopped out of the rest of this short trade, so I would obviously take profit 1 down here, but if I get stopped out of the remainder of this short trade, I still have my long trade and I would simply stay in the long trade and keep that going. So this is something you definitely want to mark, or that is something you want to note down, because this is how we as professional traders can trade a range and profit from whatever is going to happen next. And that is the best thing you can do as a trader to make profits no matter what happens next. So we don't have to anticipate, we don't have to predict what's happening next. Either way, we're making money, and that is our goal as traders. So there is a difference between trending and ranging environments. We have already identified that here. And this has significant impacts on your trading decision. So when we're trading with the trend, just to summarize, we want to use strategies like trend following or to enter trades in the direction of the trend. So if we are in an uptrend, we likely don't want to take too many short trades. What we want to avoid as well is counter trading. Whenever we identify a trend, it's always best to go with the trend rather than fading it. In a ranging market strategy, we buy near support and sell near resistance, as we've seen with this example. What we want to avoid is breakout assumptions. So, if we have a look at this once more, we do not want to trade breakouts because sometimes what we see is simple liquidity grabs. So let's have a look at this example up here. Let's clean this up a little bit. Some people might have looked at this and say, wow, we have broken the range high. We will now see continuation to the upside. But that might end in a simple liquidity grab for another rotation within this range. So I don't like to trade breakouts. If we do get a retest of a range, that is an acceptable trade. So this would look something along the lines of this: spend time and value above, then get the retest, then I can look for a long trade here. But just with the break of a range, I would never take a long trade. That is very bad in terms of the stop loss placement as well, because this would be quite a large stop loss. So that is something I avoid doing, and I avoid making assumptions if a range is going to break or not. And what we should also take into consideration is the risk management. So we should tailor our risk management strategies to the market type. So we should use a tighter stop in a ranging market, and we can be more flexible in trending markets if we are going with the trend, obviously. So let's conclude with what we have learned in this lesson. Identifying whether a market is trending or ranging is crucial for choosing the right trading strategy. Adapting your approach to market conditions can improve your trading success significantly. Once again, we have to be aware of a trend whenever we are taking a trade on the higher or lower time frames. So, I hope you learned something in this video, and I hope I was able to help you avoid taking unnecessary losses. It is actually not as difficult as it seems like if we are able to spot these trends and adjust our trading strategy accordingly. I want to help you become a professional trader starting from a beginner's perspective. So if you want to learn more, stick with this beginner series. We will be releasing 2 videos each week, so don't forget to like and subscribe and follow along. So see you next time.